3 years ago, if you told a Londoner they'd be paying double for the same home, they'd have laughed you out of the pub. But here we are in 2025, and families across the capital are watching their mortgage payments jump from 1,200 quid to over 2 grand a month. Same house, same street, same 4 walls. The only difference? The cheap money's gone, and now ordinary people are paying the price for a gamble that went horribly wrong. Over 1.6 million households across Britain are rolling off their ultra-low fixed-rate mortgages this year alone. These weren't dodgy deals or subprime nonsense. These were mortgages offered by every major high street bank between 2020 and 2022, with interest rates as low as 1.2%. People were told to lock them in, that it was the opportunity of a lifetime, and they did. Young families bought their first homes. Landlords expanded their portfolios. Middle-class professionals upgraded to larger properties. Everyone thought they'd won the property lottery. Turns out they'd just bought tickets to a financial time bomb that's only now starting to explode. The numbers are genuinely shocking. A mortgage that cost 1,100 quid a month 3 years back is now 2,300 or more. That's not a small bump. That's an extra 13 grand a year just to keep the same roof over your head. For a family in Croydon or Barking, that's a holiday, a car, private school fees. Gone. And it's not like wages have doubled to match. Most people are earning the same or less in real terms than they were in 2021. The Bank of England saw this coming. They warned about it. But warnings don't pay mortgages. And now families are discovering that keeping up with payments means cutting everything else to the bone. Interest rates today sit between 4.5 and 5.9% for most borrowers. Some are being quoted over 6%. When you're refinancing a £400,000 mortgage, the difference between 1.5% and 5.9% isn't academic, it's life-changing. And here's the twist that makes it even worse. Many homeowners can't even refinance under current rules. The regulations brought in after 2014 require banks to stress test borrowers at much higher rates. That means proving you could still afford payments if rates hit 8% or more. Thousands of people bought homes they could afford at 2%, but on paper they can't afford them at 5%. They're stuck. Can't refinance because they wouldn't qualify. Can't sell because buyers have vanished. Can't rent the place out because rental income won't cover the new mortgage costs. They've got a name for these people now: mortgage prisoners. And their numbers are growing every month. Mortgage arrears have jumped 93% in just 1 year. Repossessions are ticking up again after a decade of decline. Citizens Advice reports that mortgage debt inquiries have reached levels not seen since the 2008 crash. And the Bank of England has made it clear this isn't a blip, it's a reset. The era of cheap money is over, and anyone who borrowed heavily during those years is now facing a reckoning they never saw coming. But that's only half the story. If you think mortgage holders have it rough, spare a thought for London's renters. Because what's happening in the rental market isn't just a crisis, it's a full-blown catastrophe. Over the past 2 years, rents across London have surged by 25 to 31%, depending on which borough you're in. In places like Westminster, Camden and Hackney, the average one-bedroom flat now costs 2,400 quid a month. 2 years ago, that same flat was 1,800. That's an extra 600 quid every single month for the exact same space, often with no improvements whatsoever. No new kitchen, no fresh paint, nothing. Just 600 quid more because landlords can get it. For someone earning the London average of 36,000 a year, rent now eats up 38 to 39% of their income. Financial experts say you shouldn't spend more than 30% on housing if you want a stable life. But in London, that's a luxury nobody can afford. Once you factor in council tax, travel, utilities and food, there's virtually nothing left. Saving for a deposit? Forget it. Building an emergency fund? Not happening. Living paycheck to paycheck has become the norm for people with decent jobs and full-time salaries. Teachers, nurses, civil servants, retail managers. These aren't people on the margins. These are the folks who keep the city running, and they're being priced out street by street. The competition for rentals has become absolutely mental. Letting agents are reporting over 150 inquiries for a single property listing. Viewings get booked out within minutes of a flat going live online. Open house queues stretch around the block. Prospective tenants are offering 6 months' rent up front just to get their foot in the door. And some are bidding over the asking price for a rental, not to buy, to rent. And even then, many are being turned away because someone else offered more or had a cleaner credit history or didn't have kids or pets. It's a bidding war economy where ordinary people are being pitted against each other for the basic right to have somewhere to live. Shelter UK reports that more than 1 in 3 London renters are now either behind on rent or struggling to make monthly payments. Food bank use among renters jumped 30% in 2024, and a significant portion of those users are fully employed. We're not talking about people out of work. We're talking about professionals with salaries who literally cannot afford to eat after paying rent. In Newham and Brent, councils are placing people outside London entirely because they simply can't find local accommodation. Families who've lived in the capital for generations are being shipped to Kent, Essex, or even further afield because there's nowhere affordable left. And the terrifying part is that this isn't slowing down. The reason rents keep climbing despite falling house prices comes down to one simple fact. Landlords are leaving the market in droves, and when supply vanishes, prices go through the roof. In 2024 alone, over 50,000 private rental properties were pulled from the UK market. In London, the numbers are particularly stark. Around 40,000 homes that were previously rented out were listed for sale in the final quarter of 2024. Of those, only 3,600 found new landlords willing to re-let them. The rest? Sold to owner-occupiers or investors who'll sit on them. That's 18,000 rental homes gone from the market in a matter of months. And it's not stopping. Walk through any London borough and you'll see the signs. Entire blocks that used to house tenants now have for sale boards lining the street. Estate agents confirm that 1 in 4 homes currently listed for sale across London are former rental properties. The landlords aren't leaving because they're bored or because they've made their fortune. They're leaving because the maths no longer works. Their mortgage costs have doubled or tripled. The income from rent hasn't kept pace. And on top of that, they're facing a tidal wave of new regulations and costs that make the whole business increasingly unviable. From 2028, every rental property in England will need to meet a minimum energy performance certificate rating of C. For older properties, that means new boilers, insulation, double glazing, sometimes even structural work. Estimates put the cost at £10,000 to £25,000 per unit. Then there's post-Grenfell fire safety regulations, forcing building-wide cladding upgrades, often costing landlords tens of thousands more. Add in the Section 24 tax changes that removed mortgage interest relief, and many landlords are now losing money every month, even with tenants in place. It's not sustainable, so they're getting out. The proposed Renters' Rights Bill is accelerating the exodus. Expected to receive royal assent by the end of 2025, it will abolish Section 21 no-fault evictions entirely. Landlords will no longer be able to reclaim their properties without specific grounds like rent arrears or antisocial behaviour. For many, that's the final straw. They relied on Section 21 to manage risk, to ensure they could get problematic tenants out or reclaim the property if circumstances changed. Without it, they're selling up before the law takes effect. And every landlord who exits removes another property from the rental pool, pushing the remaining stock higher and making life even harder for renters who've done nothing wrong. Rental yields in London have collapsed to between 3% and 4% annually. Compare that to 7 or 8% in northern cities, and it's obvious why institutional investors are walking away too. Pension funds, hedge funds, real estate investment trusts, they're all pulling capital out of London property. The city that once attracted £50 billion in international investment between 2010 and 2020 is now seeing foreign buyers sit on the sidelines. The golden age of London property as a safe haven investment is over, and the exodus of big money is leaving the market hollowed out and fragile. So house prices are falling. Surely that's good news, right? Cheaper homes mean more people can buy, the market corrects itself, and everyone moves on. Except that's not what's happening. Prices are dropping, but affordability is getting worse, not better. And that paradox is crushing what's left of the property ladder. The average price of a London home was £523,000 in 2022. Today, it's around 495,000, a drop of roughly 5%. In outer boroughs like Barking and Dagenham, prices have fallen 9%. In Newham and Hounslow, nearly 7%. On paper, homes are cheaper. But here's the catch. The cost of owning one has never been higher. Back in 2021, when interest rates sat at 1.9%, a £400,000 mortgage would cost you about £1,100 a month. Today, that same loan at 5.9% costs over £2,600 a month. That's more than double the payment for the exact same property. And lenders don't just look at whether you can afford today's rate. They stress test you at 8% or higher to ensure you could still make payments if rates climbed further. That means buyers now need to prove they've got an extra £1,200 or more in monthly income just to qualify for the same mortgage they could have walked into 3 years ago. It's an affordability nightmare dressed up as falling prices. And then there's the deposit. The average first-time buyer deposit in London now sits at £144,000. A decade ago, it was £75,000. Even with 2 decent incomes, saving that kind of money takes years, especially when rent is swallowing half your salary every month. Most young Londoners aren't even close. They're renting, watching their savings stagnate, and seeing homeownership drift further out of reach with every passing year. The ladder isn't just hard to climb anymore. For many, it's been pulled up entirely. This creates a vicious cycle. Buyers can't afford to buy, even though prices have dropped. Sellers can't drop prices further without risking negative equity or selling at a loss. Banks are tightening lending criteria, making it even harder to qualify. So transactions slow to a crawl. First-time buyers give up and resign themselves to renting forever. Sellers pull their listings and decide to wait it out. And the market just freezes. Nobody's winning, everyone's stuck. But the real squeeze isn't just on new buyers, it's on current homeowners facing that remortgage cliff. Roughly 1.4 million mortgages across the UK will roll off fixed-rate terms over the next 12 months. Many of these were signed during the ultra-low rate era, locked in at under 2%. Those families are now staring down payment increases of 2 or 3 times what they're currently paying. A household paying £1,100 a month could suddenly owe £2,800. And under current affordability rules, many wouldn't qualify to refinance their own mortgage. They're trapped, can't afford the new payments, can't refinance because the bank says no, can't sell because there are no buyers, can't rent it out because rental income won't cover the mortgage. They're bleeding money every month, hoping something changes before they default. The Bank of England has warned openly about increased mortgage defaults. The data is already proving them right. Arrears are climbing, repossessions are ticking up, and we're only at the beginning of the reset. The wave of remortgages hasn't even peaked yet. When it does, the fallout could be brutal. And the people who'll suffer most are ordinary families who did everything right, who saved for deposits, who bought sensibly, who locked in rates when the banks told them to. They're not speculators or property tycoons. They're teachers and tradespeople and office workers who thought they were securing their future. Instead, they're watching it unravel month by month. And when you see the big money running for the exits, you know the worst is yet to come. London used to be the global capital of real estate investment, a city where money flowed in from Russia, China, the Middle East, and America without hesitation. Entire luxury developments in Canary Wharf and Nine Elms were sold off-plan to international buyers who never even visited the properties. Between 2010 and 2020, foreign investors poured over £50 billion into London property. It was seen as bulletproof, a safe place to park wealth during uncertain times. But that era is finished. In 2024, foreign investment into London property dropped to its lowest level since the 2008 financial crisis. Institutional landlords, the pension funds and hedge funds that once snapped up entire blocks, are offloading their portfolios. Real estate investment trusts are pulling out. The smart money has looked at the numbers and decided London property is no longer worth the hassle or the risk. And when institutions that employ entire teams of analysts to calculate returns start heading for the exits, ordinary investors should pay attention. The problem is simple. The returns don't justify the risk anymore. Rental yields have collapsed to under 4% in most of London. Mortgage costs have soared. Regulatory burdens are increasing. Tax changes have eroded profits. And the political environment is hostile. Rent caps are being discussed. Eviction bans are coming into law. Landlords are being vilified in the press and by politicians. For institutional investors used to predictable returns and stable markets, London has become a minefield. So they're moving their capital elsewhere. Manchester, Birmingham, even international markets like Berlin or Lisbon, where yields are higher and the regulatory environment is less punishing. Developers are feeling the pain too. Many have paused projects entirely. Some are going bankrupt. Others are trying to offload unsold units at steep discounts just to recoup costs. Planning permissions are at their lowest since 2006. The government keeps promising 88,000 new homes a year for London, but that would require a 175% increase in current building rates. It's not happening. House builder completions are forecast to drop another 15 to 20% in 2025. The pipeline of new supply that might have eased the crisis is drying up just when it's needed most. The safety net that once supported London's housing market, deep pockets and cheap money, has vanished. And with it, the illusion that property values always go up. You'd think falling prices would finally give first-time buyers a chance. Lower entry costs, less competition, a foot on the ladder at last. But in London, the opposite is happening. Despite prices dipping slightly, first-time buyers are more locked out than ever. The reason comes back to those brutal interest rates and the affordability calculations that go with them. A mortgage that was manageable at 2% is unaffordable at 6%. And even though the house costs less, the monthly payment is higher. Lenders won't approve you unless you can prove you've got the income to handle it, and most people simply don't. The average age of a London first-time buyer has crept up to 36 years old. These aren't 20-somethings starting families and building equity. These are people well into their careers, often dual-income households, scraping together six-figure deposits after more than a decade of saving. And even when they finally buy, they won't be mortgage-free until they're 63 or older. The dream of owning a home before 30, of building wealth through property, of having security in middle age, that's gone for the vast majority of young Londoners. London's share of UK first-time buyers has dropped from 25% a decade ago to just 15% today. The capital, once the engine of upward mobility, is now a place where aspiration goes to die. You need to save 50% of your discretionary income for 13 years just to get a deposit together. And that's assuming rents don't rise, you don't lose your job, you don't have kids, and you never take a holiday or face an emergency. It's an impossible standard, and the data shows people are giving up. Only 13% of London renters now plan to buy in the next 12 months, down from 29% in 2022. The rest have accepted they'll rent forever or leave the city entirely. The homes that are available to first-time buyers come with their own problems. New builds dominate the entry-level market, but these units are often smaller, more expensive per square foot, and riddled with hidden costs. Service charges can run £3,000 to £6,000 a year. Leasehold rules restrict what you can do with your own home. Shared ownership schemes sound appealing until you realize you're paying both rent and a mortgage for a property you only partially own, with strict rules about selling up or buying out the remaining share. People are told they're getting on the ladder, but once they're in, they often feel trapped. Unable to move up, unable to sell without taking a loss. Stuck in a property that was sold as a stepping stone but turned into a dead end. The government's Help to Buy scheme, which once fueled the first-time buyer market, has now ended. There are no lifelines left, and the result is clear. First-time buyer mortgage approvals in London hit a 15-year low in 2024. The base of the housing ladder, the young professionals and families who should be driving the market forward, has collapsed. And without that foundation, the entire structure is wobbling. What makes it even worse is that this isn't the result of a natural market correction or an unavoidable economic cycle. This is a policy-driven disaster, a perfect storm of government decisions that clashed with each other and left ordinary people holding the bag. On one hand, you've got a renters' rights bill designed to protect tenants by abolishing no-fault evictions and giving them more security. Sounds good on paper, but in practice, it's driving landlords out of the market, reducing supply and pushing rents higher. The very people it's meant to protect are worse off. Then there's the stamp duty threshold, which is set to drop in April 2025 from £425,000 back down to £300,000. That's an extra tax hit for anyone buying in that range, further discouraging transactions and freezing the market. The Energy Performance Certificate rules requiring a minimum C rating by 2028 are environmentally sensible but financially brutal for landlords with older properties. Many can't afford the upgrades, so they sell. More supply gone. Mortgage regulations introduced after 2014 to prevent another subprime crisis are now strangling the market. Stress testing at 8% rates made sense when borrowing was cheap and risky. But now, with rates already high and the market frozen, those same rules are locking out people who could easily afford their mortgages at current rates. The system is designed to protect banks, not borrowers, and it's working exactly as intended. Banks are safe, borrowers are stuck, and then there's the complete failure to build enough homes. The government keeps promising new housing targets. Labour has pledged 88,000 new homes a year for London. But planning permissions are at record lows. Developers are pausing or cancelling projects. And even when homes do get built, they're often unaffordable for the people who need them most. The maths doesn't work. You can't solve a supply crisis by reducing supply, yet that's exactly what's happening. Politicians are rejecting rent controls despite the crisis because they're worried it'll drive landlords out faster. But landlords are already leaving and rents are climbing anyway. There's no coherent strategy, no big picture plan. Just a series of reactive policies that contradict each other and make the situation worse. And while ministers debate and delay, ordinary Londoners are paying the price. So here's where we are. Landlords are being forced out by costs and regulations, taking rental properties off the market and pushing rents to unaffordable levels. Renters are one paycheck away from eviction, spending nearly 40% of their income just to keep a roof overhead. Homeowners are paying double what they were 3 years ago for the same property, trapped by a remortgage cliff they never saw coming. First-time buyers are locked out entirely, priced out by deposits they can't save and affordability tests they can't pass. The big money has fled, taking with it the capital and confidence that kept the market stable. Developers have stopped building. Banks have tightened lending, and the government is trying to fix a problem that should have been addressed a decade ago. London's middle class, the professionals and families who used to be the backbone of the property market, are being systematically squeezed out. The city that once promised prosperity and opportunity is becoming a playground for the ultra-wealthy and a trap for everyone else. The question isn't whether house prices will keep falling. They probably will. The real question is who will still be living in London when the dust finally settles. Because at the rate things are going, it won't be the teachers, the nurses, the civil servants, or the young families trying to build a life. It'll be the landlords who held on, the foreign investors who bought at the bottom, and the wealthy who never felt the squeeze in the first place. London isn't empty. It's full. Full of people stuck in a loop they can't escape, paying more for less, working harder just to stay still, and watching the dream of stability and security slip further away with every passing month. The city of Big Ben and the Thames, of history and ambition, is becoming unlivable for the very people who make it run. And unless something changes fast, the London we know, the London of opportunity and possibility, might not survive the decade.